I see we've got Eliana. Hey, Eliana, what's happening with your REW t-shirt, or sorry, your REW hat?
Yeah, representing. How you guys doing?
Doing good. Mr. Hazzi,
Hello, sir.
how's it going, my man?
Really good. Really good.
Listen, man, super excited about numbers tracking this week. Obviously, got lots of people going to jump on here and hear about everything you need to track to run a super awesome seven-figure team. And I was looking at your Renaissance project this past week, and 234 net new leads just this week on your new Renaissance site. Man, you got a lot to track, eh?
Yeah, that site's already really performing extremely well. I thought it was going to take a little longer for those campaigns to mature, but the boys are kicking ass on the PPC side for sure.
Excited. Yeah, welcome everyone. Looks like some people are jumping on here. We got some chats going on. Again, I'm Morgan Carey, CEO of Real Estate Webmasters. And of course, we have Eliana, who is our MC for REW Academy Premium. And then Coach AJ, who runs Vantage West Academy, Real Estate Webmasters customer. Absolute killer when it comes to running an awesome lead generating and deal closing business out of Kelowna. So AJ, we're going to hand you the floor as usual, and really excited to hear what you share with us today.
Right on. Well, thanks, Morgan. I appreciate that. I'm going to do a quick screen share here right now. Get this rolling. Are we in business?
We are in business. We can see you.
Perfect. Well, thanks for the intro. For those of you that haven't tuned into one of my webinars before, I am a very long-time customer of REW. I'm a broker owner in Kelowna, British Columbia, and the founder of the Vantage Academy as well. I've scaled my real estate team to this year we should do potentially over 8 million, based on the pace we're on right now, with a very highly skilled team of 15 frontline agents and 20 administrators supporting them. So big shop. But none of this could be done without really diving in deep and committing to the topic we're going to discuss today, which is tracking like a boss. And, I say this because in order to be a boss, you need to have metrics. You need to be able to quickly see at a glance how your business is doing. And the really cool part about this is you can do this from anywhere now. We live in a more increasingly remote style society. You can, once you get these things going, it doesn't matter where you are in the world. You can manage, track, and influence your numbers like a boss from anywhere in the world, which is something that is very exciting to me. As one of my core values is freedom, and the freedom to be where I want to be is very important. So this particular topic has a lot of agents, team leaders, brokers scratching their head, because there's just so much stuff that you could track, and not all of the things that you could track will move the needle. So today we're going to go through the why we need to track, what's the main reason for all of these metrics that we're going to be looking at, what exactly we need to be tracking, and I'll try to help the rubber meet the road a little bit and share with you a little bit on how to do it and how to integrate it into your business and your management style. So I'll give you the full blueprint. So let's start with why. I think it's always important to start with why. Simon Sinek says everything must come to and from the why. So why tracking? Well, number one, it's going to give you visibility. I think a lot of agents, myself included, previous to me and putting all these tracking mechanisms in place, I used to go by gut feeling. My gut feeling was pretty good. I thought I had a pretty good sense of where things were. I'm pretty good with numbers. I can carry a lot of information in my head. But what it didn't often give me was the clarity of knowing exactly where maybe the hole in the bucket is, or what it is that I need to be focused on for this particular quarter in order to move the needle. So gut feelings don't tend to translate into actionable intelligence. So tracking gives you visibility and it gives you clarity. Now, once you have tracking, you can start to look at the scalability of your business. Without it, you have no chance of really scaling a business. All you really have, you can grow, but when you look at scalability, this all comes to and from knowing your metrics. The other thing that tracking allows you to do is increase your profitability. How many of those of you out there would like to have some profit at the end of the year? I think it's very important that you're tracking. You've got to know a number of financial metrics in order to influence and understand your business's profitability. And lastly, and probably the one that is most important to everyone here, is predictability. What's important about predictability? Well, it's peace of mind. It's knowing that you can comfortably and confidently expect a certain result based on a certain set of lead indicators. So let's have a little moment here to think about this. How much peace of mind, how good would you sleep if you could accurately predict the results of your business or your revenue 6 months in advance? Right? This is so key. And one of the things that allows me to, book vacations or to comfortably know, we're good to go to invest in a new system or anything like that is I can see well into the future. I can see 6 months into the future based on knowing exactly what lead indicators I need to be watching. Because as we know, our business is, our sales cycle is 3 to 6 months in many cases. And it's the stuff that we're doing last month, this month, right now, that are going to influence how our numbers look 6 months from now. And once you know your ratios, you can say, okay, well, based on this amount of activity, I can comfortably expect X in 6 months. So it's a very, very comforting place. It gives you a lot of peace of mind, and it makes enjoying a business really enjoyable. And lastly, Phil Murphy's quote, "You cannot manage what you do not measure." So we must really be voracious about measuring as many things as we can that would influence our business so that we can manage them, so that we can influence them. Okay, so that's the why out of the way. Let's start talking about the what. And the what is, what are these data points we need in order to be able to make data-driven decisions? So I mentioned lead indicators. So the difference between a lag indicator and a lead indicator is lagging is rear view mirror management. So you're assessing the current state of your business. You're looking at the amount of deals you did last month, last quarter, whatever the case may be. And so all of your rear view mirror stuff, those would be lag indicators. But reading this information, you have no opportunity to influence anything. All you can really do is take stock of where you're at and where you've been. Leading indicators are far more important in my view, because they give you the ability to predict your future condition. And that is exactly what I was just talking about on the last slide, is that understanding of what those indicators are and how they influence the future. That's what gives you the peace of mind. So let's talk about what lead indicators are. Well, website visits are really simple. You should always know and have visibility on what your trend is with respect to traffic, and then how much of that traffic registers on your site, which these will be your leads if you're using forced registration, right? And then you've got call attempts. You should know how many attempts you're making or how many attempts your team or ISA team is making, because that amount of activity has a ton to do with how busy you're going to be 90 days from now. You need to be connecting or measuring how many of those calls result in connects, because this gives you a couple different things. It gives you the visibility on your lead quality and how your lead protocol is working. And it gives you the ability to predict how many new clients you're going to onboard typically based on a ratio of how many connects you make to appointments booked. Then you also want to be obviously tracking your appointments, how many are met and how many are signed to agency agreements. And that's for both buyers and sellers. So these would be examples of lead indicators, and you need to be tracking all these in your business. Like I say, the activity is a mega predictor of success. So for me, this is my dashboard inside of Follow Up Boss, but I can see the cumulative amount of appointments, conversations, call attempts, and texts and emails that go out. So this is over the last 30 days. And it shows me my ISA team and how productive they are. Those numbers, what that all adds up to, gives me a really good idea as to how busy we're going to be 90 days from now. I can compare those numbers to previous quarters, and I kid you not, it will come in almost exactly the same. And it's all based on inputs and outputs. So if they put in a ton of calls and a ton of emails and a ton of texts, it will result in a ton of appointments booked. And those appointments, the ratios, they hold pretty true. Once you start matching all this up to previous months, you can comfortably predict what the future looks like just by following these numbers. So lag indicators, examples would be offers written, offers accepted, how many of those become firm sales, how many 5-star reviews you get, very important lag indicator, and then how many referrals you're receiving. So these are indicators. You definitely want to know these, and you want to influence these and do your best. But this isn't your peace of mind stuff. This is your measurement and taking stock of your results. Marketing KPIs. So now you start breaking these into different segments. So your must-haves on the marketing side, we got to know our website traffic. You should know your total fan base, followers, subscribers, etc. And then the size of your total database of people in your CRM. And you should know your marketing expense ratio. So how much of total sales does marketing add up to? And I like to say, roughly 10%, anywhere from 8 to 10% is a good reinvestment guide. So as you start to generate more revenue off of your campaigns and off of your REW site, you want to reinvest. So you want to be always watching your marketing expense ratio and making sure that it sort of stays in that 10% range. And you've got your lead conversion KPIs. So you want to know your total leads. You want to know your time to first call. I've talked about speed to lead before. This is something you really want to keep a close eye on, because the closer you can get that to 5 minutes, you're going to greatly improve the next one, which is your leads to appointment ratio, right? So you want to also be tracking, I skipped the average call attempts. You want to make sure that you're not generating so many leads that this average call attempts number is plummeting, because that means they're just picking off low-hanging fruit and you're not getting the full juice out of all of your leads. You definitely need to know your leads to appointment ratio. So, you want to keep that to as close to 10% as possible. You want to know your appointments to agency ratio. So how many of those appointments show up and turn into an agency relationship, right? So you'll have a standard within your group or within your firm, and this will be something that you'll be able to uphold and watch the trends over time. Your appointments to deal ratio is a really good one. This is kind of like your team's overall percentage of how many appointments become deals, which is another way of sort of communicating the opportunity ratio, which I'll talk a little bit more here in a minute. And then you've got to have just your overall conversion percentage. So I talk a lot about, the difference between a 1 or a 2 or a 3% conversion rate on your PPC leads. It makes a massive difference, and you have to be monitoring that. So how many leads and what is the percentage of those leads that becomes a closed transaction, right? If you're getting 2% conversion, you're swimming with the big boys. But this is a number you need to know. And then, of course, that knowing this stuff allows you to scale and to watch the numbers increase over time. And you can see that as you add more leads, your transaction volume increases, and you can graph it and watch this scaling take place before your eyes over the years. And then you've got your service KPIs. So in last week's webinar, I talked a lot about the system around your client experience and your advocacy program. There's an entire system to that. Once you have that, you want to measure its effectiveness. So you start to look at some KPIs like, okay, what is my ratio of deals to 5-star reviews, right? And you'll want to watch that number, and you want to make sure whether it's 40, 50, 80%, whatever it is a standard in your business, you want to make sure you don't see slippage in that. You want a certain percentage of the people who do business with you to feel compelled to go on to Google and give you a 5-star rating. You should also be tracking your total referrals, because this is your feedback on how well your advocacy program is working. You want to also look at your total repeat clients. Easy numbers to track within your spreadsheet. Have an administrator do this stuff, but it's so important for you to be able to track your repeat and referral business as it relates to the overall percentage of your customer base. And when you know these numbers, you can see whether or not your business is getting that compound effect of not just turning a ton of people into transactions, but taking those people and turning them into walking, talking billboards. And this is a huge piece of the overall health of your business. And it's something that very few agents will measure. And it goes a long way to helping you know exactly where you stand. Because it's one thing to turn a cold lead into a customer. It's another thing to keep and retain that customer so they duplicate themselves. So this is a huge piece. Make sure that you're tracking these service KPIs. And then you've got your financial KPIs. You definitely need to know your average commission per client. This is super key because it's what allows you to forecast your revenues. And you can see whether it's going up or down over time. Maybe there's commission pressures in your area, different things. So this is something that you need to be mindful of. Your client acquisition costs, which are a couple different metrics. You've got your cost per lead, and then you have your cost per client, right? Very easy ratios to figure out, but you should know on a monthly or quarterly basis how you're doing in those departments so that you can see if you're improving over time. Is your cost per lead going down as your pay-per-click campaigns mature? Is your cost per client going down as your conversion skills get better, right? Then you've got your total cost of sale. So this is how much you're paying the agent on the other side of the transaction. Sorry, not the other side of the transaction, the agent within your organization that is handling it. So that's your internal cost of sale, as well as adding in your ISA cost of sale. And so you should know your percentage there. So you can, again, you can protect a certain margin and accurately predict what your profit per transaction is going to be. So very important financial KPIs to keep in mind. And then some additional numbers to know. You want to know where you stand against your competitors, and you'll use a lot of this stuff to inform your marketing. It'll inform some of your presentations. It'll become what you post on your website. But you want to track these things and make sure that you're doing really well in relation to your peers. So average days on market for listings is something that people love to know. Your average list to sale ratio. So how much, are you selling listings for 101% of list price when the industry average is 99%? This is knowing that number is going to allow you to overcome a lot of commission objections, that kind of thing. Your listings taken versus listings sold ratio. If you're selling 90% of the listings you take, but the industry average is only 50%, you can take that into your listing presentations and into your marketing. You want to know your overall market share, because it's important to understand, okay, if you saw 30% growth, but your market saw 40% growth, then you actually lost a step in terms of your market share and you didn't grow as fast as the market did. So you want to know your growth versus the overall market and what your market share is overall. And you want to see that number growing over time. That way you get a really clear picture of whether or not you're growing in relation to the overall market. And another one that we love to track, because as a team, it becomes part of our value proposition in terms of how we attract agents to our brokerage. And it's a nice thing to say, to the public and in our marketing, that our agents are more productive than the average agent. So you want to know and track your transactions per agent versus the industry average in your area. Okay, so that's the what. I know that's a ton. I apologize if you guys are starting to feel overwhelmed, but let me bring this all kind of into view for you and how you can manage this ongoing. I'll share with you a little bit of our playbook on how we do it and how it informs some of the other decisions that we make as a company. So the first thing you need is a scorecard. This is a very simplified version of the scorecard that we have. We track probably about 3 times the amount of stuff that you see here, but I want to simplify this. And so that you guys know, anybody that's part of the REW Academy will have access to a Google Sheets file that has all of the spreadsheets all in one that I'm going to show you guys here. But this is your weekly scorecard. And so what you want first and foremost is to have somebody on your administrative team, or maybe a handful of people. That's the left column. It says who. You put who's responsible to track these numbers. Inside sales agents are great because you tie their compensation to these tracking metrics, and you get very accurate tracking all of a sudden. But on a weekly basis, so let's just say I picked some sort of numbers that I thought might be average. You might have 500 people coming to your website per week. And from that, maybe you expect a 5% conversion on your site. So you're expecting your 25 leads. So this would be somebody that is, going to have 100 leads a month coming through their REW platform, kind of the sort of the entry point. Call attempts. You're not just calling these leads, you're calling old leads, you're calling through. So I think 100 attempts a day. This is for an ISA. Or maybe a handful of agents if you don't have an ISA, but 100 attempts, let's say, per day would equal 500 per week. And so you want to track that, how many people you're connecting with. We usually have about a 20% connect rate. So 100 connects would flow from 500 attempts. And then we have typically about a 10% book rate of appointments. So from 100 connects, we would expect 10 quality appointments, or 2 per week, right? And then you've got how many of those would show up. So the goal would be 70% show up rate. And then from there, we would want to see about a 70% signed rate. And then from there, on the listing side, you want to track the amount of listing appointments that are booked, how many are met, how many are signed. And then ultimately that leads to a certain amount of accepted contracts per week. And then obviously firm business being where the rubber meets the road. Let's just say your goal is 3. You want to make sure you have 1 or less on deals falling through. This is going to allow you to have percentages that flow from that. And then how many of those firm deals resulted in an online testimonial somewhere, right? So all of this tracks from the top of your funnel all the way down to the bottom of your funnel, and you're going to have weekly visibility in this current column. And then the spreadsheet expands, obviously, so you'll have data for multiple weeks, and that data will give you your 4-week average and your 12-week average, which is a really important number to know because it allows you to spot trends. You can say, okay, if my 4-week average is better than my 12-week average, then I'm going in the right direction. But if it's the opposite, if the 12-week average is better than your 4-week, then you're going, okay, there's some slippage happening here, right? And so you really want to have that level of visibility so that you can quickly, you don't have to wait 6 months and to have 2 bad quarters in a row before you realize where the hole in the bucket is. So this gives you really good visibility right off the bat. And like I say, you guys will all have access to this, and you can take this and put it into all kinds of other things. Google integrates with so many other data and visibility dashboards and things like that if you want to get fancy with it. And by the way, I understand this is fairly rudimentary in comparison to some of the technology that exists out there. But for me, and I use Follow Up Boss, I use Chime, I use REW CRM. All of them have great tracking components on their own, but none of them seem to have all of the full picture. So I pull from those things and populate Google Sheets, or I have my administrator do that. And then these Google Sheets will populate Gecko boards or other things that are displayed throughout my office. Is there a better way to do it? Very likely. If you have a better way to do it, I'd love to hear it in the chat. And I do want to make this a bit of a mastermind. So at the end of this, when I'm done yammering, I would love to hear from you guys, what your thoughts are, questions you might have on it. And if you're doing anything in your business that's better than this, I'd love to learn from you. Now, this is a really important spreadsheet that we keep, and it tracks on a per agent basis. So this is something that you need to know for your sales manager, if that's you, or if you hire somebody, you want to be able to track their conversion both on the buy side and on the listing side. Main reason for that is you want to be able to quickly diagnose where the issues might be if they're having any kind of trouble with conversion. So you can see here for an agent, this is just an example. Let's say they had 2 buyer appointments met, 2 signed, so their conversion rate's 100%. Then they had 2 listing appointments met, 2 signed, conversion rate's 100%. Buyers accepted, 1 firm, okay, so their close ratio is only 50%, so that might be a place to watch. Same thing. Now, as you see on the bottom, you've got OQ, which stands for opportunity quotient. And what that is it takes the amount of their appointment ratio, so how many appointments they connect with that actually sign, and then how many of those people that they actually sign do business. Those 2 numbers multiplied into each other gives me their opportunity quotient, which tells me what is the percentage of the appointments they go on that become deals. And that is something that you're going to use to track so that you can A, provide training if they fall below your team's standard, and B, make sure that your highest converting agents are getting a disproportionate amount of the opportunity. I really believe in a meritocracy. It is not something where this isn't a socialist enterprise where everybody gets the exact amount of opportunity. If you close well and your percentages are at the top of the class, well, you're going to get a disproportionate amount of opportunity. So I think that's fair. Now on the far side here, you can see 6-month rolling average and 3-month averages. And so when you look at the amount of percentages, are they getting better? Are they getting worse? Is their conversion rate over 6 months better than their 3 months? So you can see all the way through. This allows you to track and see how your agents are doing across all these metrics. So this has been a super important one for us, and it helps us take their conversion and match it to their business plan from the beginning of the year, which I'll show you how to do here in a sec. So this is what their business plan looks like. Again, super rudimentary, but here's an agent on my team that wants to make $250,000 a year in net money. So we talk in terms of net money, not gross, so their average commission after expenses and after split is say $5,000 for easy math. That means they've got to sell 50 homes to do that. How do they want those 50 homes to be comprised? Well, they want 50% on the listing side, 50% on the buyer side. Therefore, they need to sell 25 listings and 25 buyers. Pretty simple. They got to do just over 4 ends per month on average. And then based on their conversions, they need to maintain roughly 6 active listings and roughly 7 active buyers in order to hit that. So those are just lead indicators for them to be aware of if they've got enough listings and they've got enough buyers to be meeting their minimum standard. Now, here's their conversion metrics. How are they going to get there? What's their efficiency going to be? Well, they're going to convert 70% of their listings to firm deals, and 70% of their listing appointments will sign. So that'll give you can see at the bottom, a listing opportunity quotient of around 50%, which would be A-OK on our team. Now, based on those numbers, they're going to need to take 36 listings, which means they're going to have to go on 48 listing appointments per year. Okay, that means they want to take 3 listings a month from 4 appointments per month. Okay, so that really ultimately boils down to if they're going on 1 listing appointment per week, they should be good to meet those numbers. Same thing on the buy side. 60% of their buyers that they sign to an agency agreement will sign. 84% of the people they have a buyer's agency meeting with will engage them in agency services, which means they've got to take 42 buyer's agency agreements, over 50 appointments throughout the year. And you can see the numbers work out pretty similarly as it goes down. They need to go on 1 listing appointment and 1 buyer appointment per week. And that's really easy to manage from an inside sales standpoint. They can make sure that these guys are getting at least 1 of each, and they can make $250,000 a year with that. And they know that they can accurately and comfortably know they're on track to hit those based on knowing how these numbers break down. Now you take this, and this is where the management side of it comes in. So this is a Gecko board that's coming off of that last spreadsheet that we're using there. And so in real time, if I'm sitting with my agent, I can see, okay, well, let's see how you're doing in comparison to your business plan. So this agent here, you can see down the bottom, they had a goal to make $150,000 this year, and they're already at 105. So we're not even halfway through the year. They're doing very well in relation to their goal. So we can say, okay, well, let's see how that's happening. Well, currently they are roughly about 40% of their buyers. So their OQ is 40%. On the list side, they haven't done anything on the listing side. So that would probably be an area where I could help give them some training. They're not taking any of the inside sales appointments on that. But they have taken 9 listings. Okay. So I would look at how their business has been split up. You can see the percentage of their business is actually almost 85-15 buyers versus listings. So they need to get their business more in balance. You can see up here in the top right corner, their 6-month rolling average is 4.33 transactions per month. So they're doing pretty good there. Right below that, you can see we track team generated versus center of influence. And so, or SOI, a lot of people call that sphere of influence, but really who brought the business. So this particular agent has done 18 transactions so far, 14 of which were team generated, 4 of them were true center of influence. And so for them, this is really good because it reinforces the value of our inside sales department. It reinforces that a big portion of their success is comprised of team generated business, and builds that moat around our agents so that there's no greener grass. This is a big part of the retention, is giving them the visibility. Because as we know, once you meet a client, you forget the origin of it. You don't remember if they were, now you've got the relationship. So it's very easy to attribute that relationship to your own work when the reality of it is it came through the work of an inside sales agent. So this visibility, this dashboard, this is how we manage on an ongoing basis how they're doing in relation to their business plan. And it helps you quickly diagnose at a glance if there's any issues. All right, now this is, you take everyone's business plans and you inform another spreadsheet that helps you as a company do your sales forecast. So we set our goals based on this. So what we do is we will get everybody to do their business plans for the year based on some planning of what they want in their life. And there's a whole exercise that goes along with that. But once we know how many deals and what their average commission is, we'll take all of this and populate a team-wide summary. And then at the bottom, you'll see we always subtract 20% to, so we'll build our financial model around coming in at 80% of what these guys expect, but we'll build our lead generation model to meet or exceed what they need in terms of opportunity. But we always want to understand these are, driver type personalities. Sometimes they will, over predict what they can accomplish in 1 year. So we always pull back by 20%. But this is how we make our our annual budget and our annual sales forecast is basically just a composition of all of our agents and what they want to do with their lives and with their business. But all this spreadsheet stuff kind of integrates into one, and everything is interconnected. So managing with metrics, again, is to kind of go back, it gives you that visibility, and it really gives you clarity on what the current hole in the bucket is. So for us, if let's say we're looking at the scorecard, me and my partners, Michael and Nick, we meet every Tuesday and try to figure out, okay, what's going on with the numbers? Oh, we can see our deals falling through rate is progressively getting worse. Okay, so we might do a workshop in our next training session on how to keep deals together. Or perhaps we see that our buyer's agency to appointments ratio has gone down. Well, we'll look and go, okay, well, it's been a year since we did a buyer's agency workshop. So maybe what we need to do is a bit of training on the presentation. And it's astounding. Every time we do this and we do a half an hour training or 1 hour training on whatever the glaringly obvious KPI we need to improve is, lo and behold, 30, 60, 90 days later, that number has vastly improved. And then, it's just a thing. The further away you get from the training, the more, you see those numbers start to slip. But you always want to be, it's like spinning plates. You got to know which one to go and give a little spin to. And so this amount of data that you're watching lets you always make sure that your training is topical and timing is perfect for it. And it's going to be the most, it's going to give you the biggest bang for your buck. So here's another agent on our team looking at one of our top producers. He's averaging 6.33 per month. And I can see here, his appointment conversion at the top is probably the one thing on his, both on his listing side and on his buy side. He's not as efficient as he could be here, but you can see that of the buyers and sellers that he does work with, he has a very, very high likelihood of them becoming sales. So his opportunity quotient for buy sides is 50% and his list side is 66%. So it's very good. Could it be better? Yeah, we would probably give him a little bit of training on his presentation, on both sides to increase his numbers. But you can see that, his testimonials versus his deals is a little low as well. So I'd say, okay, we've had almost 30 deals so far this year, only 5 of which have resulted in an online testimonial. So I would do some training there with him. But looking at his business, 50% list side, 50% buy side, that's really good. His GCI number is well on track to hit his $275,000 net that he wants to make this year. And then again, over here on the far side, I can say, okay, you've done 29 deals so far, 25 of which are team generated, 4 of which are true COI. So again, reinforcing the team's value. So these Gecko boards are really good for the monthly sales meetings that we have with our agents. So we can give them the ultimate visibility on their business plan and continue to reinforce the model at the same time. And then last piece on just how this works in practice is always be testing different things. And it's really fun to test when you have data because then you can see and you measure the results and you can see if you're moving the needle. And this allows you to kind of be in this virtual flywheel at all times where you're testing and then you're tracking and then you're tweaking, looking for these little incremental improvements. So I showed this on our conversion mastery webinar, I don't know, two months ago. And it just shows how little interconnected levers can add up to a massive change. So again, looking at, say, your leads. So from left to right here, we're talking about a 10% improvement. So you got 1,000 leads, let's take it up to 1,100. Your GCI per deal, if you could get that from 10,000 to 11,000, so that's just by top grading, the type of clientele that you're bringing in and where your marketing dollars are spent. Then you've got your lead conversion, so your leads to appointments. So that would be improved from say 8% to 8.8%. Will give you 97 appointments versus the 80. If you can improve your show up rate, say from 70% to 77%, you're going to go from 56 appointments showing up to 75. Now, if your agents that are taking those appointments get a little better and they go from 60% sign rate to 66, now suddenly they've got 49 new clients under contract. And then if their contracts to close gets a little better, let's say you go from 50% to 55%, you can see now you've got 27 contracts sold. And then if your acceptance to firm ratio goes up from 70 to 77%. You can see you go from 12 to 21. So overall, you've doubled your income by just getting 10% better over a course of 7 different levers. So this is what we look at. Once you have the numbers, you start building tactical plans around how to accomplish certain things. Like, okay, how are we going to get our average transaction value from 10% or from 10,000 to 11,000? Okay, we could go after listings in certain neighborhoods. We could eliminate some of the lower price point stuff on our website, different things that you can do to increase your averages, right? Same thing on how do we increase our appointment show up? Well, you could value-based reminders and different things that, video bombs, etc., that can be sent out. So then you build your tactical plan around the numbers you want to influence. But again, it all starts with tracking. You got to track in order to be able to influence anything. And I'll leave you with this. This is my last slide for this presentation before I open it up for questions. And I do want to hear from you guys. I'm really excited to mastermind a little bit with you. But we take a Kaizen approach, which is small changes, steady improvement over time. That's what helps you win the long game. You don't need to revolutionize every single quarter. What you need to do is just get a little bit better across a number of metrics, and it adds up to massive wins over time. But Kaizen, how can we get a little bit better this month, or how can we get a little bit better this quarter? And knowing what would give us the most bang for our buck. What's the one KPI we need to be focused on this quarter and improving, and what's the tactical plan to make that happen? And that's how you manage with metrics. That's how you build a very scalable business that becomes a real joy and a pleasure to own and to grow. So without further ado, let's open it up to questions.
All right, AJ, thank you so much. I'm just going to pull up these first few questions here. I think the first question was in terms of all those ratios we've been talking about. Let me just go back to the question here. What are good target ratios for things through the funnel, right? So like from lead to appointment to show up to sale. Do you have like a suggested ratio or like a list of target ratios that you think are like would be awesome or good to awesome?
Yeah, for sure. So I will just go back to a share screen here and just kind of put this funnel in front of you. So can you see that?
Yeah.
So on $1,000 of paid traffic, right? For us, I would want to see my site converting around 6% to generate me roughly 100 to 120 leads, right?
Okay.
And then of those leads, I would want to use all the different speed to lead metrics. I would try to get 90% of the leads on the phone. That's about what would be my goal. And then 10% from leads to appointments is very good, right? 70 to 80% of your appointments showing up would be the ratio I would want there. 70% of my appointments should commit to working with me. That would be good. And then, the bar here is pretty low. I like 50% for commitments to deals, but in order to get 2 deals from 120 leads, you only need a third of them to buy. So, but 50% is a better ratio, in my opinion. And then I like to get 40% of our deals should be leaving a review. Those would be the ratios I would use.
You said, sorry, 40% to leave a review?
Yeah.
Well, that's the second question is how, like you and a bunch of other REW folks seem to have this thing dialed in terms of getting a lot of like 5-star reviews. I think of like Sarah in Edmonton and Justin in Calgary and you guys in Kelowna. Like, what's the secret sauce? How do you get your agents to get these reviews and like follow up and get them posted?
Yeah. So, I mean, there's a few pieces. Number one is you got to have a great process for delivering an amazing service. But let's assume that you guys all have that. Then it comes down to, in the beginning at the buyer's agency meeting or the listing presentation, setting that expectation. So there's a slide in both of our presentations that say, we know we've done a great job when you feel compelled to tell the world. And you've probably Googled us, and it's really, you've probably seen the 600 plus 5-star reviews on Google. We want to make your experience that next testimonial online. And so we tell them that, we're planting the seed at that point. Then it comes down to knowing when to ask for it. So there's usually a crescendo with every deal where they're most appreciative. And it always comes on the backside of a thank you. Not everybody's going to thank you. and those people I'll still send a follow-up, please give us a review. But there's usually a point in time when somebody says, wow, thanks for getting that deal accepted, or wow, thanks for the subject removed, or thanks for handling the broken washer dryer, whatever it is. There's going to be at some point. On the back of that, you say, you know what, it's my pleasure. One of the best things you could do for me, though, if you're open to it, is a 5-star review. And then I would direct them directly where you want that review. For us, we want them on Google primarily. So we send them a link that opens right up into our reviews on Google. We send it via text, and it usually happens right there in the moment. And that's it. We don't prompt them on what to say, but we do try to strike while the iron's hot. And then if we don't have anything, there's follow-up emails from there that go.
Yeah, I was going to say, do you use any kind of like Vendesta or tracking software or anything to try to, recapture those people who didn't end up leaving a review? Or
in the past, we've tested some, but now at this point, what we've done is we've just got our transaction coordinator has a video that goes out from me at the end of it, asking them for feedback. And if you haven't already given us a review, here's the link again. And then in their in the agent's day 1, day 7, day 30 follow-up that gets programmed into the CRM after the sale, there's a spot in there, an action item in there that says, if you haven't got a review already, these would be good times to ask again. When you're providing after sale service, ask again for that review. But yeah, that's been our system, and we get a ton of reviews. We also, in our team meeting, we read the reviews, and we always vote on the heartfelt review of the week. And so there's a little incentive there to be recognized in front of your peers. And then we give away a $50 gift card to a local restaurant to whoever got the heartfelt review of the week. And so it's a little incentive there. And, we set team goals and whatnot around reviews. So it's one of those things that's important to us. So whatever's important to you is what you end up measuring, right?
Right. So speaking of which, the third question was one on, you said you had a target profit margin per deal. So when you look at that, do you look at that in different phases, depending on whether you're aggressively trying to grow or whether you're just trying to sort of, steadily climb? Or like, are there adjustments you make to these numbers, or are they relatively consistent? Are they relatively disciplined?
Well, I believe in profit first accounting. I don't know if you're familiar with that, but there's sort of like a whole ideology around, instead of waiting for there to be profit at the end of the day, because these businesses that we're building end up being cash eating monsters, there's a certain margin that you want to extract right at the beginning. So let's just say it's 20%, and you're going to pay 10% in corporate tax. That forces you to withdraw that 30% right out of the top line and run your business on the balance. Right now, this is for a mature business. If you're doing production and you're still comprising the majority of your team's business, your net numbers are going to be much, much better than 20%. But as your business matures and you've got, sales managers and managing brokers and, a team doing 100% of the sales, you're doing none of them, and big marketing costs and et cetera, pulling 20% of gross down to the bottom line is a pretty tall order, and it can be done. We're doing it. But it's taken years to get to that point. To your point, we were investing probably a higher percentage of our money into staff for a long time. So we grew with people. We always kept our marketing right around 10%, but we added bodies way before the revenue was there, based on what most people would want to invest in their their budget for employees, et cetera.
And knowing you the way I do, I imagine that you probably forecasted out like, hey, these are the costs that don't have revenue, and there was probably some sort of recapture rate down the line where you're like, this is where it needs to break even, and this is where it needs to start contributing to profit. Is that something you have to deal with consistently? Like, are you still adding a lot of net new positions or bodies, or are you at that point now where your organization just basically is just keeping the people they have? And
No, I mean, you're totally right. You have to kind of know where your break evens are on things, but some things are you're playing a long game. Like even inside sales is one of those things. When you add that, there's a break even to it, and there's something that happens right around the 2-year mark where you get that compounding effect of the old leads coming back and the new stuff, and that's what really starts to work. But for us, the phase we're in right now is trying to just continually improve our value exchange to our agents. So we're trying to offer them more leverage. We've got this thing called leverage track. So as that's why we track your 6-month rolling average on how many deals you're at, and then depending whether you're at 3, 4, 5, 6, and beyond, you get access to more leverage. And by leverage, I mean people helping you be in 2 places at once, helping you get some of your life back. So, at 3, you're getting, a lot of sort of unlicensed administrative help. At 4, you get even more. At 5, you get access to a licensed person in a shared capacity that can help you be in 2 places at once. At 6, you get someone that's dedicated exclusively to you. At 7, we add on a VA. And so knowing kind of what those metrics are and how they relate, like knowing, okay, yeah, we're giving them back a huge chunk of their time, but does that also turn into productivity for them? And we found that it does. So it's a combination of both. It gets them to the next level and it gives them their life back. So we're always doing those equations. And the only way we could do that is if we had all these types of metrics, right? You need to know these numbers before you could take the plunge on hiring 4 new licensed assistants for your top producers, right? There's just no way. But we're onboarding people daily now because we know that it moves the needle, and we're trying to get these guys access to as much help as they can so they can continue to take on more buyer appointments, et cetera.
Right. And what is, so I know you said the 2 years is the second, is it the second year or 2 years is the magic for ISA? Like and we've talked a lot about with this for shared clients, like what, the beginning sucks, right? So like, what is that number? What's that number that you should expect that your investment in ISA, you've done all the right things, should start turning past break even and profitable?
Yeah, I would say that by 6 months in with your ISA, you should be breaking even. By a year in, you should be into profitability. It's 2 years in where it becomes wildly profitable. But you're going to lose money for the first 6 months for sure. 6 months in, you should start to see some gravy, or at least be breaking even, covering your costs. And then a year in, you should be into the profitability. And you're in the black now by 12 months out. But it just gets better and better. And it's one of those things where, a lot of people will try something for a year. Oh, I broke even on it. That was managerially intensive. I didn't really see an ROI for the amount of time I spent. I'm going to gas it and just going back to giving my leads direct to agents. And then you miss that next phase, which was when, those ISAs that have been nurturing, incubating people for a year, 18 months, 2 years even, and then those people start doing business. That's where it's magic.
And one would assume, I think we all know this intuitively, but it's trackable too. There's got to be a major impact on retention in terms of, and potentially recruiting as well. An ISA is obviously a for-profit exercise, right? But losing agents is expensive too, right? There's got to be some sort of measurement or metrics on the on the retention side of things.
It's huge. And being able to know what your ratio of ISAs to agents needs to be, and appointments, like, you know how many leads you need to generate because you know how many appointments are going to come from that. You know what your business plan metrics are for each of your agents. They all need an appointment or a couple of appointments per week. And so you can really scale your business in a predictable way when you know exactly what those numbers are per agent. And then when you can comfortably say to an agent, we have the marketing, we have the ISAs to give you exactly what you need to hit X amount of dollars, right? And that gives them a ton of clarity. And by showing them on a monthly basis where their business is at in relation to their business plan, how much of that opportunity is coming from the team, you get that opportunity to continually reinforce the model, which helps with retention in a huge way.
Nice. Eliana, we got another question. Is that right?
That is correct. It is from Gusty. Gusty asked, what pay plan do you recommend for ISAs?
Hey, Gusty, I network with you, I think, in the rate group as well. Pay plan for us is a base salary, $3,000 a month. And then we pay them roughly 5% is what it works out to on cost of sale, but it's just a flat fee of $600 per deal, but that works out to 5% because our average deal is $12,000. So, and then we incentivize them on the KPIs we want to move. So right now we're incentivizing them based on the amount of appointments they set that meet. So the appointments met is the number on a monthly basis. If they hit that, then they're going to get, I think it's $1,000 bonus, but don't quote me on that. But yeah, the incentive is if they hit their lead indicator number that we want to hit, they get a bonus, they get the per transaction, and they get the salary. So, good ISA is going to it's going to influence 100 deals probably. So you're going to probably see 60 grand in that, 36,000 in salary, plus let's say 6 months out of 12, they hit their KPI bonus. So that should get them to 100, 102 grand, right?
So when you say that metric that you're measuring, are you measuring the percentage of, or a total number, like a net number of appointments hit?
Net number.
Okay, got it. Yeah, because obviously you could get a high ratio and almost no appointments if you dock the 3 and book 3, right?
That's volume based, like, and collectively for the whole inside sales department, we also will run like 90-day campaigns. So if they hit their net number for the quarter, they all get something fun. Like we've sent them to Vegas. We've done some pretty cool just incentives to get them all working as a team to motivate each other. And you get that pure accountability. That tends to work really well anytime we do a sales contest for the ISAs. These guys, I mean, it's all about incentives, right? It's all about managing with the carrot, I believe, and giving people something that's exciting to work towards. Because picking up the phone every day on our team's behalf can be grueling. And so you got to gamify it. You got to make it fun. And how do you get people to want to track? Well, attach incentives to it.
Right. And you've often said that. You said the world runs on incentives. And I think a lot of us are in this business for exactly, at least those of us who run teams, brokerages, or software companies. You know, we're in the business of not just enjoying what we do and working with our customers, but you know, we want that incentive for everyone, right? Because obviously, if our people win, we win. So that's awesome. I think that's it for questions. Does anyone else have any other questions? Okay, so Eliana has posted AJ's at BW Academy, his website as well, and his email. So, and as a reminder for all of the REW Academy Premium members on the call, this is available for replay. We'll make those links available for the Google Drive. And of course, all of the past sessions. I mean, these sessions, guys, these are cumulative, right? This is a lot of the content that you would get working with AJ directly, right? And so these sessions, go back and watch them, right? The 7 levers and the numbers and all of these things combined are really, really valuable, and they're all available right in the Academy. And of course, if you want to do one-on-one with AJ, we really recommend reaching out to AJ via any of those channels. AJ, this has been awesome. Thank you so much. We look forward to seeing you next month, and enjoy that sunshine.
Dynamite. Thanks. Appreciate the opportunity, and hope you guys got some value out of it.
All right. Thanks, bud.